Now we're going to add number 1, number 2, and number 5 from the checklist to our repertoire, and then discuss a few odds and ends from the back of chapter 6. But before we do that, we want to do a few examples to explain why the mid-quarter convention has 4 columns. So let's move on to an example. Remember that first you must test for mid-quarter before you know whether equipment follows the half-year, mid-year, or mid-quarter test. So this is from a slide from the first part, reminding you that the half-year convention applies if the mid-quarter does not. So you must always test. So in this first example, $400,000 of 5-year property in May and $250,000 in November. We put everything together that's not a building, right? Our numerator is all equipment used for the very first time in October, November, or December. Our denominator is everything we placed in service for the year that is not a building. So in this first example, you can see that this is half-year property because my fourth quarter acquisitions do not exceed 40%. So just a quick review of using the tables when we have half-year property, and we know it is half-year property from the prior slide. Basis method, modifying convention. When we're using row 1 of any table, our method and our modifying convention are together. So our 5-year property, the basis was $400,000. It was used property, so we did not take any bonus depreciation. And we're starting at number 2 of the checklist. And so we used the whole $400,000 times 20%. So our answer for the first year is $80,000. Remember, no bonus, and we're ignoring number 2 on the checklist. Here is the 5-year table, and the 20% comes from the fat column, right? The fact that it is half year means we get 20% in the first year. And then in this example, the 7-year property is also half-year property, even though it was placed in November, because we placed less than 40% in total in the fourth quarter in this particular year. So basis method, modifying convention. Remember that when we use the modifying convention, when we use the tables, the modifying convention is built in. And here we go, 250,000 times 14.29. There's our math, no bonus, ignoring number 2. Here is our 7-year table, and here's where the 14.29 is coming from. So make sure you own your tables, and your math will be a whole lot easier. So now we're going to change up the example. We're going to add another piece of property placed in service in December. So we've got one 7-year property in November, one 5-year property in December, but it doesn't matter because everything except for buildings, regardless of the recovery period, are part of our numerator if they were placed in service in October, November, or December. So we're running the fraction. The fraction is the fourth quarter acquisitions divided by total acquisitions greater than 40%. And here the answer is yes, because we put 700,000 in October, November, December, and altogether we had 150,000. So it was 63%. So the 5-year property is first quarter, a mid-quarter 5-year property. The first 7-year property is fourth quarter, mid-quarter 7-year property. And the second 5-year property is fourth quarter, mid-quarter 5-year property. So now we've got 3 different pieces of equipment going down 3 separate columns of our tables. We need to make sure we know what we used for year 1 so that we'll be able to move down the rows to subsequent years and do our math correctly. Now we're going to do the first year calculations for all 3 pieces of the property, starting with the 5-year property placed in service in May, second quarter, mid-quarter property. Remember, basis method, modifying convention. Our basis, our modifying convention is 25%. So here's our answer. Remember, no bonus, starting with number 2 on the checklist. And just to make sure that you're reading the tables correctly, here's where the 25% came from. For this piece of property, we will always be in that second column of the mid-quarter section. The only way we can go is down. Next, we'll do the 7-year property. Fourth quarter, mid-quarter, 7 year. So we need to switch tables. The percentage is 0357. So here's our answer. No bonus. Ignoring number 2. Here is our 7-year table. And this time we moved over all the way to the very last column in our table. And so it's year 1. So 3.57 is both our method and our modifying convention. And then we'll finish up with our second piece of 5-year property, which is fourth quarter, mid-quarter, 5-year property. We spent $400,000. This time the percentage is 5%. So our answer is $20,000. And here's our table. Notice we've switched back to the 5-year property table. Fourth quarter. So we're going to be in the very last quarter again. And that's where our 5% is coming from. And then, of course, we are moving to the second year. In this particular case, we took no bonus depreciation or other immediate deductions. So we know that our bases will still be the full $400,000. We know that it's second quarter, mid-quarter, 5-year property because of the math we did in year 1. And so having established both of those points, we're ready to move on and calculate depreciation for year 2, a year where we owned it the entire year. So that means we do not need a modifying convention. So we're going to stay in our tables. So we're going to get 30% from our table. So our answer is going to be $120,000. And here's our 5-year table. We are second quarter. So you can see where the 30% is coming from. All right, we've simply moved down 1 row in our second quarter, mid-quarter property table. So this slide is just a quick reminder of what happens when there's an early disposition. Use the same modifying convention going out that you did when you came in. You can use my little formula here or any other way that makes sense to you. Remember, buildings, our denominator is always 12. We count months. We count back to January. If it's mid-quarter, our denominator is a 4. Once again, we're counting back to January. If it's the half-year or mid-year convention, we are simply going to get a half a year regardless of when we disposed of it in that early year. So you can use my formula, which is 1 minus 0.5 over 1, or you can just say a half is a half, and I'm going to take 50% in a year of disposition. So now we're going to sell all 3 of our pieces of property in different years and different quarters to get some practice. Remember, regardless of when we sell it, it is still second quarter, mid-quarter, 5-year property. So we're going to sell it in year 4 in July. So take a good look at your table. Make sure you remember that that second quarter is my column, and all I can do is go down. There's been a disposition, so I will need to apply a modifying convention, which is the same convention as I did going in. So it's a mid-quarter convention. And that means I put a 4 in the denominator, count my quarters back to January, subtract 0.5. So the 1137 from the table, I sold it in July, January, February, March, April, May, June. July is in the third quarter. So there's the math for that. So my math will be what you see there. And just to make sure you know where the 11.37 is coming from. So here's our other 5-year property. So we're staying with our 5-year table. This time it is mid-quarter, fourth quarter. So we are changing quarters, columns, but only because we have a different piece of property here. Right? Sold in year 2, so we want to use row 2. Sold in February. So that's 1 quarter or fraction thereof, minus 5 divided by 4. Basis method, modifying convention. So 38% from the table. Here's our mathematical answer. And just a reminder of where the 0.38 came from. All right, now we're going to sell our 7-year property, also fourth quarter, mid-quarter. Selling it in year 3 in April, January, February, March, April. So April's in the second quarter, right? Because our reference point is January. Here's our 7-year table. All right, we're going to stay in that last column making sure every time you're at the right table. So you need the 7-year table. Get your basis method modifying convention so you can see where your numbers are coming from. Your answer is there. And just a reminder of where your percentage is coming from. Now we're ready to open up number 2 in our checklist. Code section 179, election or limited expensing. These are similar terms for the same thing, which is the ability to write off a certain amount in 2013 up to $500,000. That number has dropped dramatically in 2014, and unless Congress changes it, it'll only be $25,000. There's a phase out, which means that the richer you are, the less you get. You've done several phase outs now. This one is based on how much eligible equipment you place in service for the year. So that's the wealth measure, if you will, for this phase out. And if you spend more than $2 million in 2013, you do not get to deduct anything in your 179 expensing column. Not available for buildings, just for property. So here is our spreadsheet. I'll let you read checklist. I'll let you read it to yourself. What we're going to do is we're going to use the first 12 lines of the 4562 to do our math. It'll handle the phase out. It'll handle B. Qualified business use. I'm leaving you to read about that. You can read about it in the outline and in your How to Depreciate Property, publication 946, and in the instructions to the 4562. You will get a question or two about what qualified business use is. It's nice and clear, easy to read. I suggest you read it before it's time for the depreciation part 2 testing. And note that you cannot use it with equipment in a rental. So if I have an apartment house and I have put in some appliances in the kitchen, I cannot use 179 expensing. And just like with bonus, you reduce basis before going forward. And note that 179 expensing is number 2, bonus is number 3. So you take care of this provision first, reduce your basis, and then move on to see if you can calculate bonus depreciation. So we also have the chart. When you need to go back and get a quick answer, you can refer yourself back to the chart. Remember, limited expensing is not available for buildings. And then here's what part 1 of the 4562 looks like. The one you have in your packet does not have anything on lines 1 and line 3. There are some complicated additional variations of this that are still available in 2013 that we are not dealing with at all. We're going to use the straight vanilla up to 500,000, tangible personal property, and the phase out starts at 2 million. All right, so we're not going to worry about the more complicated things. Most of them should have totally disappeared by the end of 2013, unless Congress takes some drastic extender action after the November elections. So here's our first example, starting at number 2 on the checklist. Placed in service $425,000 of 5-year property in May. The business income for line 4562 is $1 million, and we'll talk about the reason for that shortly. So we're going to start with number 2. Remember, if you expense, reduce basis before moving on. Then go to number 3 on the checklist if you have any basis left. And then test for mid-quarter and determine whether it's half year or mid-quarter, because we're only talking about equipment, right? Not buildings. And it's then we're right to our normal basis method modifying convention. There's certainly many ways to do this math, but if you can read the line instructions for line 1 through 13 of the 4562, you don't have to memorize anything. 1 and 3 will already be pre-printed. 500,000 is the maximum we can expense. Line 3 is 2 million. That's where the phase out starts. The phase out is dollar for dollar. Every dollar you're over $2 million. Line 2 simply says what all eligible property added up, write it down. Line 4 simply says, by how much am I over $2 million? And here I'm clearly way under 2 million, so line 4 is a 0. Line 5 says how much of my $500,000 has survived the phase out. And in this case, it's all of it because I placed in service less than $2 million. Line 6 and 7 simply say, okay, how much do you want to expense? This is an elective provision. You could choose to expense $100,000, anything up to $500,000 based on our first 5 lines. In our case, we haven't spent more than $500,000. In fact, we've only spent $425,000, so that is the maximum that we can deduct. Line 8 simply says add up line 6 and 7. Line 9 says enter the smaller of line 5 or line 8, just in case I wasn't paying attention and I put $1 million down on line 8. Line 9 brings me down to my maximum deduction, which here is everything I spent. Line 10 is carryover of unused deductions from prior years. You use something similar when you did the investment interest expense limitation. The amount you don't use just carries over with the potential to use it in the future. Line 11 is that business income limitation I said we would talk about. You cannot use this provision to create a loss. Remember, we had the same thing with the home office deduction. Sometimes they just put limits on your ability to use the expenses from one venture against others. The business income limitation is a pretty complicated calculation. I am not going to hold you responsible for it. I will simply give you a number to use there. And in a little while, we'll see what happens if that number is less than my line 5 amount. So in this case, my business income is $1 million. This says enter the smaller of $1 million, or line 5. And so line 5 controls here. So 500,000 on line 11. Line 12 says add 9 and 10, but do not put down more than 11. And so we're back to our $425,000. Line 13 is the carryover. We've managed to use it all this year, so there is no carry. So let's look at the math on this set of facts. Our cost was the $425,000. We're recovering all of it through limited expensing. Line 12 of the 4562, number 2 on our checklist. So there is no basis left. So we can't do any more than take 100%. So we're not going to take any bonus depreciation. We're not going to take any table depreciation. And our final answer is we have recovered the entire $425,000 in one single operation. So in our second example, we're placing in service more than $2 million with a 5-year property. So now what we have to do, once again, is start with number 2 on the checklist. If we are allowed to expense reduced basis, check out number 3. If we do take bonus, reduced basis, test for mid-quarter, and then calculate basis method modifying convention. So here is our 4562 part 1. And you can see that I only left in 5 lines, because if you get to 0 on line 5, that means that you are mathematically incapable of expensing because you have placed too much in service during the year and your $500,000 has been completely phased out. So remember, the $500,000, $2 million pre-printed on lines 1 and 3. Line 2 is everything other than equipment that's qualifying property. Line 4 is a simple subtraction. And then 5 is another subtraction. If negative, write 0. So I was over the full 500,000, so there's nothing left to expense. And so while I'm theoretically entitled to number 2 on the checklist, I am mathematically deprived of getting any kind of answer. So let's go ahead and get the answer. All right, so basis, the original cost, $5,225,000. We're not taking any limited expensing this time. So our subtotal for determining bonus depreciation is the whole number. This is new property, and so we are entitled to bonus depreciation. And so we get half of what's left after limited expensing is considered. And the remainder is what I'm calling the line 19 or table basis. And it's simply the other half. May, so no acquisitions in the 4th quarter, so everything is half your property. Basis method modifying convention, and since we're in year 1 and using a table, the number I pick up will be both my method and my modifying convention. So I take the basis that's left. This is 5-year, half year, so it's 20%. So my final answer is the sum of line 12, line 14, and line 19 on my 4562, or $1,515,000. In this next example, once again, we placed in more than $2 million, so there will be a phase down this time, but not a complete phase out. Go through number 2, number 3, test for mid-quarter, basis method, modifying convention. So here's our 4562. This time, line 4 indicates that we're $125,000 over our phase-out start. And so we're going to lose $125,000 of our ability to expense the whole $500,000. So our line 5, which is the maximum deduction we can take under this provision, is $375,000. Now this time on line 6, column C, I chose to put the whole $500,000 just to show that it doesn't matter because line 9 will catch me back up to the $375,000. Line 8 says add up 6 and 7, which is $500,000. But line 9 says enter the smaller of line 5 or line 8, and I'm back to my $375,000. Line 11, we had $1 million for our business income limitation. So our line 11 is the same as our line 5, and we are allowed to expense the full $375,000. Now let's run through the math. Our basis, we start out with the $2,125,000 reduced by our limited expensing. That gives us the amount that we presumably could take bonus depreciation on. We go back and check our facts, and indeed it is new property, so we are entitled to expense. So we get 50% of what's left after limited expensing. The remainder of the basis will be what we take to the tables. All acquisitions are now in the fourth quarter, so this is now mid-quarter property. You've got to absolutely check this every time, right? If you don't triage through all the steps, if you don't stop at number 4 and look at exactly what you placed in service and when, you are going to just grab things, right? You're going to grab the 7-year property when you mean the 5-year property. You're going to use half year when you mean mid-quarter. So slowing down is really important here if you want to be successful. Basis method modifying convention. 0357 is the amount we get for fourth quarter, mid-quarter, 7-year property. And so our final answer is line 12, line 14, and line 19 for the grand total that you see there. In this set of slides, we're going to look closely at the line 11 business income limitation. And when there is a limitation, the answer as to how much you could expense gets pretty complex because you could choose to expense more than your actual income so that you can use the carryover for next year. You could choose to expense nothing, or you could choose to expense just enough to use up your business income. And so when I want you to focus on this particular concept, I'm going to ask you to tell me what's the maximum amount on line 13 of the 4562. So the line 13 is how much of the amount you chose to elect for this provision you did not actually get to deduct. Right? We want to follow our pig rules, right? If we can't deduct it, we still want to maximize our carryover so that we're all doing exactly the same thing. So we're going to start with number 2 on the checklist, but I'm not asking you to go any further. So all you have to do is use lines 1 through 13 of your 4562, and you will have successfully answered this question. So here we go. We had $725,000 on line 2. So there is no phase out. We're under the $2 million. So at least in theory, we have the right to expense the full $500,000. So that's what we're electing. So you're seeing the $500,000 on line 6, 8, and 9. But line 11 catches us up to being able to deduct no more than our business income limitation, which is $150,000. Remember, your business income limitation is not your net Schedule C before depreciation. It's more complicated than that. I'm not going to ask you any complicated questions about it because it just doesn't come up very often. So the worst you will see about this will be you're having to put the right numbers on lines 5 and 11 to get to the right number for 12 so that you can determine what your carryover is on line 13. So in our particular case here, the fact we only have 150,000 of business income means that line 11 is only 150,000 instead of 500,000. So that's all we can expense on line 12. And the remainder is our carryover that we can use in subsequent years.